Hello and welcome. This is the Mutiny Investing Podcast. This podcast features long-form conversations on topics relating to investing, markets, risk, volatility, and complex systems.
So I know you did your undergrad in philosophy. Did you do postgrad work in philosophy, or is it just undergrad?
No, I got tempted down that path by a professor of mine. But, you know, the funny thing about philosophy is it's a good framework for understanding the world. But then, like, if you want to actually get out there and mix it up in the world, you just got to get out there. You can get cloistered pretty easily. You know, you see these guys go for a PhD and then they never leave the university. And I just didn't think that was the path. Money's pretty cool.
Well, you just outlined like 3 questions for me to go, and so I got to choose my own direction. It's like, we'll get into maybe like the guys that just stay in there because they like that ivory tower like philosophy, or like continental style, or you're just debating what the definition of is, which is just annoying. But like I find that when people go for the undergrad side, it's either you actually love philosophy, which is probably a red flag, or you like want to be a lawyer, or like you said, it's a way to like think and build up that postgraduate work. But it sounds like you're actually somebody that loves philosophy.
I started in international relations. I was thinking that could be an interesting path. I still think it might have been, and then got pulled into philosophy because it was sort of the keys to the kingdom on like winning arguments, which at the time, I mean, I still love debating, you know. Yeah. As I met this guy, this professor of mine, Rhett, he was doing his doctorate at the time, and was just an awesome professor. Like, the guy made me think, you know, more than anybody else really had until that point, in a meaningful way. And he was just an absolute gangster on the words as weapons front. And so I just sort of followed that thread for a little while. Got deeper into, I think I sort of majored in philosophy on accident. You know, I just like started taking all the philosophy classes, majored in English for a while. But yeah, the thing that I like about it is the way that it allows you to intake ideas and filter them in a disciplined way. So, you know, ideas come from all sorts of sources, and they're just kind of floating out there in the world, and a lot of them are just weird and toxic. And so it gives you this kind of, you know, mechanism for filtering out the good from the bad. I love that. It's super. It wasn't useful for a very long time, and then I got into business. And as you like climb up the career ladder, it sort of kicks in like in your late 30s. Philosophy becomes useful. So it's like a long bet on yourself that you're going to make it to a level where it's actually useful in the world.
I was thinking like you almost have to like in your 20s, like while you're working your way up the corporate ladder, figure out what you want to do. It's like you almost have to shut off that philosophy brain. You don't want to be asking too many questions because like you want to maintain those paychecks. And that's addictive.
I mean, the first thing when you're junior I mean, people hate it when I say this, but when you're junior, it was a very hard lesson for me to learn. The first lesson is like you just got to learn to obey. You know what I mean? Right. Like you get into this hierarchy, and you just need to learn from others what the local domain knowledge is and how you can fit in there. And that is just an exercise in fitting in, which is very frustrating, especially if you've got sort of, you know, inquisitive mind and you get in there all fired up to, you know, make a difference and all that. You just can't until you learn the ropes, and a lot of that is taking dictation from others. It took me a while to get that one.
Yeah, it's interesting how like you said, most of schooling, especially K through 12, and then even into undergrad and postgrad, is about creating cogs in the machine, right? Learning to obey. Yeah. But then if you're studying philosophy the right way, you're actually learning the opposite, right? You need to learn to question everything, define your priors. Like you said, it's an amazing way to build an infrastructure for debate. And actually, you know, I didn't realize we were that close in the ideas of like, I actually started an international business, and then was taking all the 400 level comparative religion classes, and they're like, you know, you should just major in comparative religions. You've already done all the work. And even though that's to me like religion incorporated philosophy, especially I was specialized in like Eastern mysticism, like Sufis, Taoists, etc.
Awesome.
And so, but then I went back later in life and read philosophy because in school, my first teacher, it's always dependent on that teacher. Like you said, you had a great one. Is like that first class I had was like that more continental style philosophy, like define what is in the sentence. And I was just like, it was just a bad teacher. And I was like, this is terrible. So I went away from it and then came back later. And like you said, when I like that, you know, autodidact learning, because then I was just a voracious reader of philosophy. Because like you said, it makes you define your terms. But part of that, I wonder, we're going to come back to the philosophy, especially your philosophy on Twitter, but part of that is I always wonder why the skeptical tradition doesn't do as well as any sort of like additive tradition. Is it just because we love to create mental frameworks and everything and we don't like ones that destroy them?
I think that's part of it. It's, it's hard to sell. Like,
Right.
it's almost a pure antithesis. So you're walking around the world with this framing of like what's wrong about this. And I think that is good. It's good hygiene, but it doesn't really get you anywhere. It's fundamentally non-generative. You're just sort of like stripping away the things that would hold an idea back. It's a very useful thing to have in an organization, but by itself it doesn't make anything. So in a way, a skeptic is almost always, it's a weird way to frame it, but you're almost always a team player as a skeptic by some broad definition of team.
You think you're always, or you're not a team player?
I think you are. I think you have to be.
You are? Really?
I think so, because you're effectively looking to strip the chaff away from the wheat, right? Like the goal of a skeptic is to almost enforce discipline, but that's non-generative. Like you're not creating anything.
Right.
You're taking an idea. It's a refinement process, and so I think that it's similar to when you do these brainstorming exercises. Like the brainstorming comes first, and you don't really want skeptics in the room there. And then once you have that seed of an idea, then you bring in the skepticism and you refine it down into something that is, hardened and like more world ready. It's basically the function of it.
No, this is beautiful. I love that you brought it up this way and think about it. I never thought it in the team player sense, but I get what you're saying now. It's like, I wonder, like, do you think though then people like us are maybe like bipolar or schizophrenics? Because like you just said, it's like when you're having that generative discussion, I always say at my firm is the improv yes and. Like, just don't kill this baby. Like this thing's so inchoate, like it needs to be nurtured and watered, and like so we can't be skeptical, right? We got to get this idea out there. Then once I can get it to a place where I can almost steel man it, then the other part of my personality comes in and goes highly skeptical and tries to tear it down. And like you're saying, it's a refinement or a honing of that process. But to have those two people in one mind is kind of like people think they're competing forces. I just wonder like how you deal with it as well.
I had a long stretch of my career where I'm not sure I have dealt with it. I had a long stretch of my career where it was hard to make forward progress until I started partnering with people. And the guy I founded our startup with, this guy Ben, he is a prolific creator. Like he's high output. He and I generate ideas together, and we sort of swap back and forth between the refinement and the output hats. But for me, a lot of that's just working with people. It's so great to have an external sounding board for ideas so that you're not sitting there trying to wear like gear shift between these hats all the time. And then these days I just try to always hire people who are kind of high output players and ideally better at what they do than I am.
That's the wisdom of age, right? Is like we just start surrounding ourselves with just great people and kind of, but at the same time you had to build that world. It's an interesting thing too. It's like you're essentially creating to go from 0 to 1, you're creating an idea, taking an idea from your head and bringing it into the real world. And that is almost like creating a hologram. And even though you then search out people that are much better at you at doing their individual tasks, you are still that energy that holds that hologram together. So it's a really weird feeling to like every day you wake up and you almost have to animate this hologram. And the amount of energy that takes, even if most of the people are actually doing the actual physical work, so to speak, it's a weird construct where you're basically building a worldview.
Yeah, and I think that skeptical framing comes into play when you have, if you find yourself as a manager of a team, it's a very useful skill set because oftentimes in business, you've got a team, they've got objectives, and there is sort of cross team chatter around like, well, is this the way to do it? Should we do it this way? And if you can stand there as the skeptic and sort of protect that little pocket that the team works in, that's pretty valuable, right? Like, do we really need to pause here and think about what we're doing, or can we just keep running? The skeptic is sort of it's the warrior at the gates. And if you've got a group of creatives who you're working with, it can be a really useful skill to kind of be the blast shield for them.
But as we're almost like we were talking about right before we hit record, is about the idea of shiny object syndrome. Is like, but how do you maintain that? Being skeptical and knowing like this may be refining the business and we need to go in this direction, but I also may be falling for shiny object syndrome. Like, how do you deal with those two trade-offs?
It's a challenge. I mean, some of that probably comes down to the industry sort of traditions. I mean, in software, we've got I think Agile was a really interesting evolution. You know, in the beginning, there was this waterfall thing where it's like you have this massive design and then you spend many years implementing it, and then the design comes out. Well, the world picked up the pace so fast that there were legitimate critiques. There was sort of a legitimate shiny object syndrome in response to that, which is the industry changes so fast, this isn't working. We need to be able to move midstream. And so Agile is this notion of like, we're gonna sort of decide on a couple weeks worth of work here. We'll do that work uninterrupted, and then we'll pause and have a period of feedback. And so you get these rapid iteration cycles. And I think that's at some level, protecting against shiny object syndrome is defining a span of time that everyone is bought in on, where it's like just the work happens in there. And then you pause and you shift for feedback. And you know, Agile done half well allows for this intentional gear shifting. It's like build mode, take input mode, build mode, take input mode. We separate those. Super effective.
But that's why I wonder if that's a particular thing with software development is as you start to play in all these other fields besides just the software industry, especially you start getting into global macro and you start to deal with all these nebulous things. It's like it feels like that's a great function of software is you can actually go on these sprints and actually get that feedback where you can't really get that in a lot of other industries.
Yeah, I think the closest analog in trading is probably just knowing the timeline that you're playing on. Like the funniest thing on Twitter is you get most of the like vicious arguments on there are literally just people disagreeing on time frame, right? Like you got a day trader who's laughing at someone who has a 2-year thesis on something because it's going the wrong direction that day, and I think that's probably the closest analog to Agile, which is like if you got a trade, know when you're wrong. Like sure, maybe there are indicators that come in there and invalidate that ahead of time. But in general, if it's a 2-year trade, put that thing on and then, kind of wait. And I think I think that spins people out a little bit on the trading front sometimes, right? Like, a 2 year, you got to be able to wait for a long time and have a bigger pain threshold sometimes with those. Yeah, the dollar trade's a great example, Everybody was bullish the dollar on the back of COVID, like the thing sank. Now it's ripping again. And I think I think that for those that were in that thesis over the right time frame, that's ultimately validation of the view. And if you were trying to trade that thing as as somebody who has to do quarterly reports or something, that would have been pretty challenging.
Well, as you see with Brent all the time, clients or other people just want to hate like on an inter-month basis versus like, what's the thesis? The way I always talk about it these days is like, everybody's got all of these theses about whether it's dollar, which is much broader, or like an individual public equity. And I'm like, you're going to put together a steelman thesis. I get it. And I'm probably going to fall for it due to behavioral functions, or I can try to steelman the other side, but that leaves us with nowhere, right? Good philosophy is almost like Carneades, right, in a way. So it's like, I keep saying is like, I don't care what your thesis is. Tell me your position size and tell me what the rest of your book looks like. And then we can talk about if it's hedged properly or whatever. And if you're taking a flyer on that small percentage, but like you just said, I also need to add into those two dynamics is the time horizon. Tell me the time horizon of your trade. But at the same time, I think that's the one thing that retail has an advantage on, like you just alluded to, is time horizon. They don't have that sharp stick of clients at their back and like monthly liquidity or like a quarterly earnings report. Is like if you have a different time horizon, then it's different things. So like, to your point, like on Twitter, I think, like you said, people are arguing about time horizon, but I think even more importantly, it's like people are always arguing about like a singular trade, and I find it completely pointless unless we're talking about the overall portfolio. Like as you and I know, even like to just use Brent again, it's like he has a very convex way of trading that dollar position. That's a tiny fraction of his book, but like nobody talks about. They think he's like just all in on the dollar or something. Like it just doesn't work like that. Yeah, not at all. And I think the flip side of that is like you get into these back to your point about the advantage of retail. I think that's the only advantage retail has. Yes. Yes,
It's
I
time
agree.
horizon. Like the ability to just sit there and the ability to do something else, like to not focus on it, right? Which is a powerful advantage. I think it is. The more you self-identify as a trader, the less you're able to realize that advantage, because there's this desire to have a wall of 7 screens, watch every little tick on 10,000 different things. But the beauty of macro is like ideally it's set it and forget it, and you're planning for every scenario you can see, and you're constructing a book. You're more of an allocator than a trader, right? And you're constructing this big book that's just sort of, it's as bulletproof as you can make it, and then you tune that.
Yeah, that's. I keep frequently talking about like everybody thinks I hate global macro, which is not true. I just hate that everybody has like these global macro narratives. It's almost like a philosophy of everything, right? And I'm just
Yes.
like, it just doesn't work like that. Where like what you just pointed out is to me the best global macro traders in the world are great micro traders, right? And they're great trade constructors and portfolio constructors, because like you said, they're thinking maybe 2, 3, 5 years out what can happen, and then they look at the secondary or tertiary effects to try to construct trades with large asymmetric convexity to the upside. And it's Hugh Hendry used to talk about it like centipede. He doesn't mind chopping off 5 to 10 of his legs because he's got 90 left. And
Totally.
and that's it's also, it's once again, it comes back to what's trade construction, position size in your overall book. I don't care about your big theory, philosophy of everything about how you think the world works. That's just self-aggrandizement. But that's what everybody focuses on, not the actual trade construction of their book. So people feels like they're
It's just
focusing on the wrong
easier to
things.
sell stories. All of it's like, to me, it comes back to the business model. And I think if you're looking for somebody to hand a chunk of money to them, I guess the thing that I would sort on is probably their mechanics around risk management. Like, when do they have a framework for being wrong? If they have a framework for being wrong, it's like, okay, well, I'm just going to pull that off. That is going to be, you're going to get a better outcome with them than you will with somebody who is deeply invested in their beliefs, which is a very weird thing. You want this sort of light touch, like, maybe I'll take a shot at this FX trade or whatever. Then it goes south on them. They're like, all right, well, I either mess up the entry or they just pull it off. Like that is a powerful skill set, and it is almost the opposite of the skill set of narrative trading. I mean, narrative trading is very, it's like I always think of it as you're out there in the ocean, and instead of just riding the waves, you're like pulling boulders out there with you on your surfboard, trying to drop them in and make the wave. It just seems so futile. It's really wild.
What scares me even more, though, is like it's different as like an institutional allocator, and you have people that trade very niche strategies. It's really great to pick up on those. But like my issue is like more the newsletter. I'm not going to pick on anybody specifically, but like the newsletter writer luminaries in like global macro space that talk about like dollar, monetary operations, etc. Is how many clients or potential clients I've talked to where they're like they just follow that one person religiously. And to your point, I'm always like, what if they're wrong? Right? If they're betting everything on inflation, what if they're wrong? Or the opposite. If they're betting everything on deflation or disinflation, what if they're wrong? And they never think about that. And I think you're just like me. It's like the idea of following somebody else religiously and doing everything they say and then not seeing their trades or anything like just doesn't make any sense to me at all. Yeah. And so, but why do you think that? So maybe we'll get into this. So why you find global macro so fascinating? I think about it as like there's nothing more enticing for older white males that if they made a modicum of money in life to then become a global macro trader and have a philosophy of everything, because it's like you become like a thunder god, right? Like it's just there's nothing more, because like we said, it's become like a philosophy of everything, and so it's just the most enticing thing. And I'm just wondering what like dragged you in.
I think a lot of it is like it's the way a liberal arts degree was designed to be used, right? So like if you think about where liberal arts comes from, liberal arts was essentially a generalist education for the ruling class, right? And so like you get a little bit of money and you feel like you're finally able to make use of this weird BA that you got a long time ago, right? You're like, oh man, I know a little bit about all this shit.
Yeah.
And so it's seductive in that way, right? It feels like you can put that education to work. And I think that some of that is just an outright mirage, right? I think it's certainly a part. There's a truth in it, but you have to take all of that with a grain of salt because unless you're approaching trading in a way where being wrong doesn't hurt you, right? You're gonna get hurt because you're mostly wrong. Like if you can do macro in a way where you're seeing a lot of these opportunities, you're planning for 80% of your trades to be wrong, and you still make money. That's a powerful thing. But I feel like that becomes this afterthought, and all of the narrative, like I've cracked the case here, detective crap gets put in front of that.
Yeah,
and that mangles people.
Yeah, it's not a Dan Brown book. That's what people need to learn. Exactly.
Yeah.
Like my partner Taylor always talks about, like what you just nailed is like he talks about, capital allocation is the apogee of a liberal arts education done right.
Yeah. Yeah.
But at the same time though, I wonder what I deal with, and I don't know if you deal with this, is like if you're a founder, CEO, or you run a total portfolio solution book or whatever it is like it's part of like our maybe insecurity about like we're a jack of all trades, master of none, and we can't actually apply for a job. So we create these jobs that like, no, I'm good at like capital allocation, like says like the laziest man ever.
Totally. I'm more of an idea guy, really.
Exactly.
Yeah, it's the same thing. I mean, I think inside of that there are these fun little things that you can unpack. Like the reason I got so obsessed with treasuries as a structure is that it's like, it's a hedge that's positive carry. That's awesome. And people come back and say, well, it's not a hedge in an inflationary environment with a real. Sure, it still is. It's a hedge against an environment where there are a bunch of people going insolvent because it's the only place to run, right? It's money. And I find that to be fascinating. I even wonder, I spend time thinking about these systems. Should that even exist? Or should a hedge always be negative real return? Like, have we finally found equilibrium in the system now that we're seeing treasuries be a negative real return? I think perhaps, right? Like a hedge should bleed you a little bit. Otherwise, there's something wrong, there's something off in the systems dynamic there. No,
you nailed it, and it's to have a positive carry hedge for the last like 4 decades is, like you said, it shouldn't exist. And then do you pay for it in an inflationary environment, or do we go so negative that you're still getting that hedge? But also, once we get towards the zero bound, you start losing convexity of that hedge. When rates are like 6, 7, 8%, you have a lot of actually convexity in that hedge, which is really nice. Not only positive carry, but a lot of convexity. But that's actually one of the things I definitely want to dive into is like, it's really rare, I think, for somebody with like an entrepreneur mindset to then be obsessed with treasuries. Like it's almost anathema to that's not usually what, it's not usually the creative people that are so fascinated by treasuries. But like kind of break that, I think you actually said it really succinctly, but kind of break that down more is like, you just view it as like, this is essentially cash, or you and I have talked about privately, it's like the time value of money, or all these things. But like, do you think about it more as a barbell where you're just looking to put most of your portfolio in treasuries because you look at it as like a positive carry hedge, or like, talk to them a little bit more and dive into this?
Well, now let's lean into the theory of everything bit.
Okay. Yeah.
All of the economy is treasuries. Everything is a derivative of the price of money. All of it. So part of my interest comes from a background as a current gig as an operator, where you're thinking about what does the price of money mean for business. So if the price of money goes up, let's say tomorrow, the Fed gets sick of all the bullshit and just whatever sets rates to 5%. What does that mean? That means that if you're running a business, you have to get a risk-adjusted return of more than 5%. Otherwise, investing in it is irrational. Now, what happens if we push it down to nothing, like we just did recently? Well, it's pretty damn easy to get a risk-adjusted 1-2% return. Like so much stuff. I mean, if you create a basket of companies to invest in, you're probably going to win. Like it's not that hard to carve a couple of points out of the economy. So the more expensive money is, the more disciplined operators have to be. And so all of this just kind of ties back into the price of money. The price of labor ties into the price of money. So I think there's, I look at the treasury market as sort of the spine of the economy. Everything, whatever happens there ripples outward into all decisions that economic participants make, independent of whether or not they're aware of them. And I don't even know it's possible to see all those little ripples, but it's an endlessly fascinating thing to attempt.
So I want to push back a little bit because I think this is great because this is the question I always have. Especially this is why I said it's rare for like an entrepreneur, founder, operator mindset to love treasuries as much as you do. In the sense that like I remember, back when I was a commercial real estate developer, I don't really care what the price of money is. I care about the delta of my return over the price of money. And so, like, we've had cap rate compression in commercial real estate, but that's because the price of money comes down. But the delta has never changed, that percentage delta. So if rates are 6% and my project can make 10%, I have a 4% delta. If rates are 1% and my project makes 5%, I have a 4% delta. The delta has not changed. And then, as you know, in software, is like it doesn't matter really where Fed funds rates are at. Like lately, like if you wanted to use, Pipe or some other sorts of financing, as a software company, it's going to be like run at like 12 to 18% interest only. Like that hurdle rate's huge. Like what I'm saying is like, I've never understood if the hurdle rate kind of adjusts up or down, you still need to be able to make a delta. And I'm not sure if that follows the economy or where it front runs the economy. To me, like those rates are following like the directional arrow of disinflation or whatever. And it's like, so if as a company, like you said, if you're now, previously, let's say in the 80s and 90s, you can make a double-digit return on like your cash flow, on your CapEx spending. Well, now you can maybe only make 4 or 5%. So you're hurdling that 1 to 2%. But I'm saying like the delta, I'm not sure the delta changes. This is the thing that ruminates in my mind all the time. So please push back on it.
So I think it matters, and I would say I'd be willing to take the strong stance that rates are causal.
Okay.
And things emanate outward from rates. And so here's how I think that happens. Let's say you got the real estate example is fine, but let's just say you're financing CapEx, right? So so I got a book. I build a book around. I just put out a bunch of business loans. And I'm lending it out at whatever, 8% or something. Rates are 2%. And I look at that and I'm like, damn, I could go borrow. Like this is great. I'm getting 6% gravy here, but I could go borrow at 4 or 5%, lever this shit up, right? Like 3 to 1, and get 12, 15%. So I go out, I take the money, take 7-year money, lever it up. The reason rates are causal and the reason there's a lag is people get caught out in that refi moment. Mm-hmm. So it is if you're making the spread, right, and you can take cheap money to make a little more, the effect of rates rippling out is whoever gets caught in between where they need to refi their leverage to catch that gravy, and it's not there, right? And I think this is what you see I think this is the way that the rate movements translate into the economy is you catch operators out. And you catch operators out when they're pretending to be financiers.
Excuse me. That's a great way of putting it. But like, as you know, as the banks create the money, not the Fed. So it's like they're just using that hurdle rate. And then banks now we have shadow banks that are doing lending on top of banks. And they just look for the risk to reward, like you said. So like if they feel they're going to finance SaaS companies, they're going to look for that like 12 to 13% return, even if they're borrowing at like 2 to 3%. Because like you said, they don't want to get caught out. But part of that, though, that I've always been fascinated by, that I'm curious your take on, is as an entrepreneur operator, we both know that cash flows are lumpy, right? They unfortunately don't come on the first of the month or on a bi-monthly basis. So it's always been fascinating to me is like, why do we have financing structures that have deterministic pay down dates or deterministic cash flows when none of us have deterministic cash flows? So and that's why people get caught out, like you're saying. So it's like, how do we, from an entrepreneur, if I'm thinking about running a lending company, how do I make it, amenable to entrepreneurs to almost time with their cash flows? I mean, I think some people do it with, convertible notes and maybe taking a percentage of profits or, all that kind of stuff. But like, don't you think that's the largest function? And that's maybe how the Elliots of the world or whatever that lend to own is because they know people are going to default because of just structural payments on a bi-monthly or monthly basis. Yeah. It's inevitable.
And I think all of these, whenever you see big rents, it's like a bunch of people hit a bump. I mean, it's really kind of trippy. I think this is one of the things that, if you're a participant in the economy, you want to look for those broken structures, like the positive carry hedge, and you want to seek them out. And I think SaaS is one of them currently. It's getting a little more efficient, but
say more.
Brilliance of SaaS
is
it's to create a deterministic cash flow. It's awesome. It's the best business model ever. And you see, and when you look at these companies, like who's hitting the bump right now and who's already hit a bump and who hasn't. Apple hasn't hit a bump. That's a little weird. You'd think, you look at that and you're like, it's a hardware company. Like, you'd think they'd be getting hit. Well, if you unpack that a little bit, part of what they've done is they've put a bunch of their users on subscription plans for iPhones. So you pay them monthly, and then every couple of years they just ship you the latest variant of whatever phone comes out. It's brilliant. So they SaaSified their hardware to a certain extent. They made their cash flows more deterministic. You have all this App Store income, which is like in aggregate as a basket, fairly deterministic. And they've just smoothed out their entire P&L. And I think that it's almost like cheating. If you can make your own business very deterministic, it's really, really powerful stuff. You know?
But what do you think about
a SaaS P&L is beautiful. You can just crank that thing up or down. You have so many levers.
Well, and that's why the multiples keep going up on SaaS P&Ls. But like,
yeah,
that's what I wonder. It's like, Buffett, made this whole insurance and float model that everybody loves. But then I think as other hedge funds try to get into like owning insurance companies, it's easier said than done. So same with SaaS. It's like, yeah, everybody would like a SaaS-like income, but that's the other part. It's like easier said than done, right? And you have this Red Queen principle to it, and maybe everything's what you pay. And when these multiples expand because everybody wants that SaaS-like income, does that drive down the abilities to where then if they hit a bump, we're either over levered or we can't maintain those cash flows.
Well, so let's talk about the risk side of SaaS businesses.
Yeah.
So I think that the danger of SaaS is that you have to be a pretty savage operator in SaaS, and you can fall asleep pretty easily during bull markets, which this one has been very long. I'd argue that we're still in the same one since '08, maybe coming out of it here, and a SaaS company is essentially an extremely high beta organization at the organization level. So when GDP is growing, what SaaS does is go and compete for a disproportionate share of that GDP with these awesome models that are easy to scale, and you lever up hard. Typically we do it with equity capital, but it's still it's the same thing. You're levering up, right? You have a burn rate. You're spending into a deficit continually to take ground. And then when the economy turns, you have to be high beta that way too. So you got to cut quick, because if it becomes a dog eat dog game, like you have a P&L that is designed to capture a disproportionate percentage of the upside, and now what we're talking about is an environment where it's down, like someone's going to lose. When GDP contracts, people go out of business. There's just less business. And so if you're hyper levered as GDP is contracting, you're going to have a bad time. I mean, you can still pull it out, right? Like you can still compete hard and all that stuff. But typically, it's why you see tech start to cut first. We're seeing this now, right? Like you've got all these early, like a lot of tech companies, they're pausing hiring, they're doing cuts. Nobody's really sure where the economy goes next. I still think we're headed into a recession because it's sort of due or whatever. Doesn't have to be traumatic. It just happens. And so you're seeing people adjust to that. Now, the challenge is that during COVID, there's a real recency bias problem here, because during COVID, a lot of these same companies, they did the thing, right? They pulled out their little shelf plan, they made a bunch of cuts, and then we turned around and said, you know what, we're going to kick this recession out a little bit because it seems like there might be an ethical problem with allowing it to happen now. And so all these companies had to turn around and rehire. And so the inflationary burst that you saw in goods and services happened with labor as well, right? Companies got caught out. We did the right thing as operators. We made cuts, and then the economy hit the gas, and it's like, oh damn! Now there's this hyper competitive labor environment. Everyone had to staff up, and so now all these operators are sitting there, looking at what looks to be the time where you start to do some cuts again. But the last time we did that, the Fed came in and saved the day, ish, and so I think that's why you hear that in the economic narrative, like, well, maybe the Fed's got our back. The Fed's going to pivot. This is the big meme right now, right? The Fed's going to pivot. I'm not so sure. I mean, the reason they did it last time was arguably a societal, ethical reason. To experience an end of cycle recession during a pandemic, which we didn't have a lot of information about, It felt wrong. I don't know that it feels wrong right now. Like, I think it's okay to rinse the balance sheets right now, and I think the Fed's fine with it. It's been a little ham-fisted. They're out of phase. They probably should have started tightening like 6 months into COVID, and there's all sorts of arguments around that, but I don't know that they're going to be squeamish. We'll find out. What's your take?
Well, I always start with my first question is always like, would you want that job? Everybody likes to pick on the Fed, and I'm just like, I can't imagine like being a human in that scenario, especially during like COVID and all those things. And like you said, it was an ethical thing, and I honestly think they actually probably did the right thing. And then like you're saying, you're kicking the can down the road. I understand all the arguments around both sides, but it's just like, I can't imagine having that job. What a nightmare of a job.
It's a terrible job. I don't know if I would want it. I don't know that I would do anything differently, but I would do it I would probably do it quicker, just because of where I think we are. Like, the moves they're making are not bad. They're just doing it at an academic pace, not an operator pace. And I think that that's where the source of the damage will come from. I think that they are going to create damage here with this tightening. I mean, right now, if I were the Fed, everyone's going to hate this, I'd probably stop tightening. I think we're pretty tight here. I think you just let it run out over 4 or 5 years. Because there's this choice here. Do we like grow into the liquidity push, or do we, squash it down and wash it out? And there's all sorts of arguments both sides. I think there are some good ones for either one. But I think the extreme political response here, where it's like, oh my God, inflation, this is going to be Weimar Germany. It's not. And that feeling that we're having about it could create something that is decidedly the opposite of Weimar Germany if we're not careful about our approach,
But I was thinking about what you said about the SaaS cuts is like, once again, going back to this, what we started with, the idea of time horizons. And to me, it's like, I think this is what you're saying. It's like, basically there's a dichotomy in the economy right now. Is like, service jobs are alleged looking for employees, raising, that wage price spiral on like the minimum wage on the service side. But like you said, the tech and SaaS companies here in Silicon Valley are like, they're cutting as fast as possible because that's what they should be doing. But it's interesting how then like on Twitter or FinTwit, like the value investors are looking at like those tech companies and like, even like Coinbase, or especially the FTX Coinbase kind of crypto side, and they're like, look at these guys, they had to cut, they're losing all these employees, they don't know how to run a business. And you're saying like, no, they're doing the right thing in this scenario. They have different time horizons.
Yeah, it's the right move. Because if you don't cut, there's two things that can happen. One, you can die, because that P&L, in the same way that SaaS businesses, and to a greater extent even payments businesses, they're sort of like super SaaS. They ramp really slow, but you have a ton of momentum behind them. If that presumption, that forward presumption of momentum is going to change, you need to be ahead of that change. So like, you need to start adjusting when you see that at the top of your pipeline. Like, you get these deal pipelines that are multi-month long, and the minute you see weakness there, you got to sort of adjust your plan, because otherwise your headcount growth and your spend will get way out of phase with revenue 6 months down the line. So the SaaS operator is a forecaster, always. You're always sort of forecasting where your revenue is going to be down the line. You're trying to pull forward deals, get people to do yearly stuff and all that to manage cash flows. But if you find yourself caught out, it can be deadly. And the second thing is, you could fail to capture an advantage. So let's say let's say you have plenty of cash, right? There's no risk of whatever. If you're in an environment where labor's really tight, which we have been, and you are nobly heading into an environment where there will be a bigger labor pool to choose from, and you hire those hires in the tight environment versus the future environment where there's, where it's more competitive, you've lost an edge. Like, you are hiring from a smaller set of potential candidates, and there's lost edge in that. And so I think a really good SaaS operator almost has to have a macro view, because you can't really get all the juice out of that business without it.
Yeah, but I think Med Faber and I were having this discussion yesterday. It's like the idea of like VCs, if anybody, should be able to like invest counter-cyclically because they do so much better, but none of them do, right? They're always just riding that ramp up. And it's like, so as an operator of a SaaS company, how do you, it's hard to invest counter-cyclically or turn those taps on and off because, like you're saying, lagging effects, and because it's real human beings involved. So like, do you then like hedge the treasury with being long treasuries or derivatives that can give you a pop? Like maybe you're buying puts on the NASDAQ as a proxy with basis risk for that drawdown. That way you can actually invest counter-cyclically. Like you said, if you can hire into that trough, like you can just outcompete everybody. How do you think about that on operating the business? Like how do you operate your internal treasury balance sheet counter-cyclically? With those kind of environments, but when you're ramping up, you need to ramp up. So it's like, it's really hard to do that.
Yeah. The treasury function in software companies, it's an interesting thing. I suspect there is, I suspect it's under optimized, but I would be wary of attempts to optimize it. So, like a good SaaS business can, even at scale, can experience like 100% growth a year. What are you going to try to get a couple points on there?
Right.
Like, you're talking psychotic growth already by digging deeper into the specialization of operating. And so like I don't think there's anything wrong with just leaving the treasury in actual cash, like 3-month T-bills or something. That's fine. Could you get more out of that? You could, but the risk of fucking that up is extreme, because if you lose money that could have been put toward a 100% year-on-year growth business because you're trying to get an extra 3 or 4 points, that's bad. So I guess I would say there's probably uncaptured opportunity there that shouldn't be sought. Like I think even the most clever treasurer, maybe you're doing a little currency hedging. I don't know. You have to be huge to make it worth that. Like how many headcount?
That's tough.
What are you buying? 4 or 5 engineers? What are they going to do?
Well, or the way I would think about it, like I think it is incredibly difficult. But if you're having that 100% year-over-year growth, if you carved off 2 to 3% to buy some deep out of the money puts on NASDAQ, that will give you some explosive convexity that then you can maintain. You maintain that balance sheet, or even maintain that payroll if like something like COVID hits, or buy up competitors, or start going on a buying spree and building out even the asset side. It's something I think about often, but obviously I have a one-track mind when it comes to that. So
I can see arguments for doing it. I don't know if okay, so let's say you're the CEO of a company like that, and you advocate for that, and people are like, okay, if you how do you get caught out there?
It's different if, like you said, you're not doing capex, and maybe because of treasuries you need to use such large amounts of that cash. Maybe it doesn't make sense. But if you're using derivatives that have enormous amount of convexity to them, you can carve off a little bit of that. And you're going to take basis risk on NASDAQ because it's not going to perfectly align with SaaS, but like. It may give you like an ability to ballast your treasury or balance sheet. It's a little more fortified in case of a downturn, because we saw that downturn represented in NASDAQ.
We did, yeah. I think that and again, most of my experience is private companies, so like there's no tradable equity involved.
Right. So you take basis risk. I would say, for sure,
yeah. So I would say there's probably a pretty interesting business in outsourcing the treasury function for software companies. I just don't think they should be doing it. Like there's so much for the finance team to do. You can gain triple whatever you would get from this effort, over time, from just sort of like being really good at running your P&L, keeping expenses tight. Like there's just that the finance team inside the company should probably not take this on. It's low risk reward. But if you were to build a company that did this and offer an outsourced treasury function for startups, I think that might be interesting.
Yeah, so it's like you said, it's too much of a distraction internally, and then the last thing you want is your internal finance department to destroy the company while you have this high growth SaaS business.
Yeah, because they get obsessed with macro.
Yeah, you're like just keep it in cash.
Yeah.
I don't want to fuck this up.
Yeah, exactly. I just want to know it's there, and along the lines of this, the debt markets are endlessly fascinating.
Yeah,
I think some of the other stuff that gets overlooked is like there are probably things that are really close to treasuries that offer a little more. Like one of the things the example I always use is like JP Morgan bonds, like 2-3 year new issue stuff. You're probably going to get an extra point on there over treasuries. And they probably are like treasuries. You know what I mean? Like, I don't think we're going to let JP Morgan go under. We've sort of tested that thesis, and like, there's no appetite for that. So I think you can do little things like that that are relatively simple and relatively smart, and like get a couple points with very little effort. And then if you're doing anything more advanced than that, and you're an operator, you really got to ask yourself whether you're getting distracted by shiny object syndrome, like at the finance level.
Right, and you just don't want to get too cute. You start getting into JP Morgan, it starts opening that Overton window, like maybe we could take a little more risk, I'll get a few more points. And it's like, why are you trying to get a few points when we have 100% year-over-year growth? But that's why I think it's fascinating.
I heard of a treasury that was in these yield codes. So they got venture money, LP money, and they're putting a portion of their treasury into these DeFi yield codes, and like you got to imagine these people are getting rinsed. That's a career ender. If you do it wrong, you're getting set back a decade in your career.
Yeah, it's like that's why my partner Taylor and I originally got together because we were talking about stable coins back in like 2017, 2018, and I was obsessed with them. But like to me, what we build with like our cockroach fund is a form of stable coin, right? If you hold all the world's asset classes, you hold global stock, global bonds, you hedge it with long volatility and commodity trend, and you own gold and a little bit of crypto. It's like, to me, that's the world's inflation basket. We don't need to debate CPI or core PCE. Yes. And then like if I just hold all the world's assets and rebalance, that is a stable coin. But more importantly is you can lever it or delever it however you want it. So to me it's a beautiful thing to run a treasury with, because you could toggle down the if you had like a 4 or 5% real return with like a 5 or 6 vol with a 7 or 8% drawdown, like that's a form of like stable currency, because like people don't realize cash can go into like you had like a 17% drawdown in a single year on cash in the 70s. So like people don't realize how much cash can get hit. So you just want to outpace inflation, and that's my argument. Is like if you had a stable coin that outpaced inflation, that's all you need your savings to do, which personally savings, but and for a company that's your treasuries, your savings, and that's what you want it to be incredibly boring.
It's the whole goal of a hedge fund, right? Blunted beta.
Exactly.
Like, that's it.
Rebalance some betas and you'll be just fine.
Yeah, like just cut the tails off. And the thing I think, it's very difficult right now because for two reasons. There's pressure on fees, which I think is very silly. And then there is this just crazy desire to chase those right tails. And you can't do that. You can't do both. Like, I think on a big picture look here, the fees are worth it for all of those reasons we were just talking about. Unless you're like, you can't afford to do it right. What are you going to go out there into the world and compete against a bunch of math PhDs? Like, maybe you're smart, but you're not that smart. They're doing it full time, right? You don't have that kind of bandwidth.
I wonder how. See, and then you've been part of. Go ahead. Sorry.
And then the other piece is like, if you're chasing upside as an operator, you should be doing that on in your daily job. You should not be doing that with your finances. It's just bad. A lot of people they put a big win on the board, they get their ass handed to them afterwards.
So that's part of it. So this leads to an interesting question. I remember friend Andrea, the chef at El Bulli, used to talk about if we didn't have to eat food 3 times a day, it wasn't a quotidian thing, then his art would be seen as a high art. It'd be like a painting on the wall, like you'd go, wow, I can't do that. But because we eat 3 times a day, we figure, I can be like Ferran Andrea, I could be like El Bulli. And so I wonder, like you're saying, like they transition from being like an operator to then thinking about being an investor and looking at global macro. It is amazing to me how people think they can dabble in their part-time job and compete with the smartest minds in the world, but like it's still always enticing.
Yeah. Well, and you know what? It's fine to go have a gamble. Like, get out there, try it a little bit. Get yourself a little trading account, punt a little bit. You're on balance, you're probably going to lose, but like that's a fine hobby. It is. Yeah. It's irrational to think that you can outcompete someone with even a small staff who's running a proper hedge fund.
Especially I'm in these long vol and derivatives guys, and it's like their staff of PhDs trying to figure out like just this tiniest details, and then somebody thinks they can find stuff publicly available on the internet to like compete with them and buy options. I'm like, just don't trade derivatives. It's not DIY. That's a terrible idea.
Yeah, it's a terrible idea. Yeah.
But part of it, so there's one last question I had about SAAS before we go, to change subjects, is like, so like you said, the right move at the company level as an operator is to cut quickly. But you're a human being. And those are, headcount is a way of saying, but that's real people. So like, I just like, so like, it's unbelievably crushing and keeps me up at night to manage people's savings. But I can't imagine having to fire dozens or hundreds of people that you've created friendships with. So like, how much does that weigh on you when you, even though it's the right move for the company, it's a horrible move from a humanitarian perspective.
It's like voting, where like, you don't necessarily like one or the other, but sometimes you just got to get out there and pick the lesser of two evils. I mean, like when if you're cutting staff, it's oftentimes from a belief that if you don't, you're effectively cutting all the staff. Like you're saving jobs.
Right.
If it's a real drawdown, I mean, it sucks. Like firing people sucks. And I think when we were running our company, I think we would get flack for not spending the money fast enough, which sounds funny, but is also like there's a logic to it. If you're in a run up, you really want to hit the gas as fast as you can, or you'll get beat on the field. But I think we, in the past, this is when I was CEO of this company, I think we ran more defensively for this reason. Like we were understaffed almost perpetually. Part of it was just I wanted more control. I didn't want to ever have to raise money, because in the first few you have to, and it's just unpleasant. The dynamic is unpleasant, and then when you go raise money when you don't really need it, it's just it's a conversation amongst equals about the future of the company, not someone grinding you for what they can get out of you. So I think that there was a whole range of ways to play that. One is to just run a little tighter. The other is like, I think what I'm seeing a lot of people do right now is, when you get a little whisper of doubt, you just cut the forward headcount, which doesn't really impact anybody.
Yeah.
Right? You cut the forward headcount. If people leave, maybe you don't restaff those roles. There's ways to just sort of like, it's similar to the Fed, like letting treasuries roll off versus selling them, right? There's a default sort of reduction in an operating business that doesn't involve firing people, just because you get some turnover. And the question is like, are we going to replace that turnover? If the answer is no, there's an organic shrinking that happens that doesn't really involve ruining anyone's day or like firing people, any of that stuff. So there's a wide range of controls to deploy there, and I think that part of the advantage of looking farther out into the future when you're a SaaS operator is you can pull those levers quickly, the easy ones. You cut back your marketing spend. That's another classic one. You can sort of tell when SaaS companies are feeling a little weird because they'll cut the marketing budget, like literally just what you spend on pay-per-click ads and stuff, right?
That's because you can shut it down so quickly, which is nice. Yeah.
That's right.
But
anything that's a toggle, you just turn it off.
But I was trying to remember who wrote it prior to COVID. There was a article that was really making the rounds that like SaaS is like the most like Citadel like business, because the last thing people are going to cut is their SaaS products because they need them to run their business. But I think we found during COVID that might have changed. I was just curious what you thought before and after and during, like if you debated that ability that SaaS was the last things that people would cut.
I always thought it depends on the SaaS. It's very situational. This is probably, as someone inside the industry, I it's hard for me to see it as a pure aggregate, just because there's such a
it's not a monolith
zoo that I live in. Yeah, exactly. So I think it really depends. So let's take an example. Salesforce. It's very hard to turn off Salesforce. Once you're in there, they've done a really good job of this. It's very useful software. I know everybody likes to hate on it, but like if you're on a sales team at scale, you're using it. So I don't think they're going to cut that back. But what they will do, so let's say you got a big company that's on Salesforce, whatever, 1,500 people, right? Salesforce is priced by seat. So if that company trims 300 people, that is an organic reduction in Salesforce's revenue. And this is the thing that SaaS companies are a little more exposed to, is that if you see a wave of unemployment, it almost necessarily structurally hits SaaS revenues.
No, that's a great way to think about it. It's not a on-off switch, it's a toggle switch, and you can kind of pre-predict, especially if you're paying per seat, how that toggle is going to change, and at least they don't lose the entire contract they are losing some of that revenue,
right.
but they're not losing the entirety of that revenue. It's not an on-off switch. I always wonder, have you ever invested in like Constellation Software, or do you maybe think about that as like your benchmark, or you're like, I'm trying to internally create vertical SaaS companies, so I'm competing with Constellation, and I believe my hubris thinks I can beat them?
There's a lot of schools of thought on this one. One of my favorite books on management, because it's the one I'd reach for if I just had one book to recommend somebody. It's called 12, The Elements of Great Managing. It's Gallup. They did a bunch of research. It's like, what causes people to stick around at their job? And they have a bunch of stuff in there that's fascinating. Like having a best friend at work is really important. There's a few things that show up in the data as what makes employees happy, and you can just do those things. It's pretty great. Makes everybody, enjoy work more. One of them is, I have the tools I need to do my job. And you see this a lot with engineering teams, I work with a lot of engineers. If you are building SaaS as a derivative of that observation, I think you should be building best-in-class software, not all-in-one software. So there's sort of these differing approaches, right? Sometimes these SaaS companies try to come in with an all-in-one package where it's like, we do everything. And those companies tend to hit bumps more often than companies who come in and we do this one thing really well. So the one thing really well example, Carta is a great company. They do cap table stuff. They'll do your 409A. It's very niche, and they're bolting things on that are narrowly adjacent, but they're not trying at this point to be the full back office suite, right? Because when you become like the full software solution for a department, it gets a little weird. It means that package was forced on someone by finance because it was a good deal. And I think that those companies probably are a little more resilient in downtimes. But I think a SaaS company that builds itself to be able to play well with an adjacent ecosystem and say like, yeah, you want to use our XYZ features and use this other company's other thing, I just think that's a better play. I think it makes employees happier, and you're not going against that friction all the time in sales.
And a part of it's like by niching down, you almost become even a more integral part of the business, so they're less likely to cut you in a downturn. So that you get like the dual function there, that goal. I want to go back to bonds and treasuries and everything, and I think you and I've we've texted about this before, but like it's one of those areas like it's just always been hard for me to understand. That's why I also said it's like it's interesting to me for you as like a founder, operator, entrepreneur to like treasuries so much, is because like when I think about my commercial real estate days, it's like if you think about like Howard Marks has talked about, if you're a fixed income or like sort of trader, all that stuff is like you only have downside risk. You don't really have upside. Like the only thing that can go well is that the terminus was exactly what you thought it was, but the path along there is going to be a nightmare, and it only has downside risk.
Love that framing.
So
Marx is great.
And so and then for me as a commercial real estate developer, to me those loans were essentially like dumb money, right? Because there's no upside to it, and I get to take all the upside in a leverage fashion, right? But then I have the commensurate risk on the downside, except for so do they, right? If it disaster, the keys goes back to the banks. So that's why it was always kind of hard for me to always understand treasury or bonds. But then like looking at the entire history of it, especially sovereigns, is like it looks like the Rothschilds and maybe Nathan Rothschild like came up with the idea of like really advocating for government bonds because they got totally tired of financing despots and going after wars and then getting the reparations after the wars. So they created this entire market, and so that they had something tradable, and it was also allegedly unlocking the landed gentry of England because you couldn't get access to that capital. So, but if you could get them to bet on government bonds, now we open up that capital that was previously almost like buried in the soil, so to speak, because it was part of their landed gentry purposes.
Totally.
So when I think about those structures and then this game is part of that game, like I always wondered why we even have them or why they exist is what my real question is. But like part of that, like you were saying, is like the size. Is that why we have them? Because you can move such large size, and this is the one instrument that can handle massive size. And that's maybe the really the point of, like you said, is like people are never want to really hold cash. We're looking at diversifying or distributing our collateral in times of need, and this is the one place, especially with maybe U.S. Treasuries, is like where you can actually get in size, and that's why it makes sense. It's more just like a sizing market, even though it's kind of a fictitious market in my mind. You might think it's much. Yeah, I think you probably think it's much more real than I do, but
So I think that you're right, and I think I would frame it slightly differently, but it's the same insight. So arguably the original, not bull case, but like, I don't know, reason for being of markets is to help business succeed, right? That's like why we still think that they're a good trope. So,
Right.
so the simplest version of that to think about is futures markets on commodities, right? Like I can sell. Like, so if people get obsessed with this at a micro scale because people love to be Luddites with old ideas. So CSAs, a CSA is a futures market for one person. That's what it is. You're pre-buying the produce. It's
Yeah.
October wheat or whatever, but it's the farmer has a little more discretion and they just give you whatever the hell they have. But you're buying October wheat, right? You're pre-buying this farmer's produce so that farmer can de-risk their cash flows.
Right.
And so, there are different prices in CSAs. You see these futures market structures evolve. Like if you buy in early in the CSA, you're taking more risk. It's cheaper, and then the people who buy in later and later pay a more expensive price. Then the season starts and things closed. It's very much like these concepts keep resurging even on these small scales where people think they're being unique. But the treasury market is just that for money. It's just that for money. Like it is a commodity market for money, and a big liquid market lets people de-risk their business. It's awesome to have a big liquid market for operators. So if I know that I don't, that I have, I don't know, $100 million of cash in the bank and I only need 10 for the next few months, I can buy treasuries, get a little yield on it. That's awesome. And all of that stuff allows people to move in and out of from cash to financing to deploying the money. Otherwise, if you have a non-liquid market, you get the same problem you had with the gold standard, right? Which is like
Right.
there's an incentive to hoard capital. And if you get an incentive to hoard capital, what you get is these really jagged markets, right? And the more jagged pricing in markets is, the more operators just get bodied. That's the real problem. That's what we're trying to solve. We want to smooth markets. We want highly liquid markets that don't jump around a lot. And I think that if we're to bring this back to sort of the challenges that the Fed is going through right now, and the reason why it probably would have been good to raise rates earlier, we got a jagged up market. Just this huge ripper. And now we have to decide whether we want to address that by a big down jag, which is the current plan, seems a little weird, or whether we just want to have 10 years of low growth where we grow into that liquidity. That's just not very American. And people don't want to do that. And you know what I mean? Like, that's not how America rolls. America takes the pain economically. We always do, because we want to get back into that growth mode. The growth mode makes us happy. And we just had too much growth mode. So now we can either have a long, protracted period of non-growth, or we can take a bunch of pain and get back to the growth thing as fast as possible. I think we're going to do it.
And then do you think in that scenario, by front running, right, and we take a little bit of pain, but that little bit of pain ends up spiking the dollar quite a bit, as we've seen, which absolutely destroys the rest of the world. So then we can get back to growth mode even faster because we cycled it through. We worked on a faster OODA loop than the rest of the world. Is that kind of the way the thinking works?
There's a lot of accidental stuff in international finance that is ultimately fairly unfortunate. But when we think about the dollar, why is the dollar the reserve currency? There's a lot of hot takes on this stuff. If you observe what makes a reserve currency historically, it's whoever controls the trade lanes. Rome had roads. They invented roads. They were the reserve currency because they controlled the trade lanes, and if there was a dispute, they were going to resolve it. This is the way it exists today. America has the biggest stick. So if you bank with America, you eliminate one of the main risks in banking, which is that America will come along and invalidate your holdings, which is what just happened with Russia. What happened with Russia is a doubling down on the power of America as the reserve currency and the banker to the world. Because if you're banking with America, America will not come along and invalidate your bank. If you're banking with Russia, they might. So I think that you have that. That's just this pre-existing dynamic, right? Now, as a derivative of that, the things that America does has these crazy ripples in the rest of the world. And I think what we're doing now is we're solving a domestic problem. The domestic problem is we have inflation and people don't like it. So we're going to crank rates up, and that is going to explode a bunch of other economies. And like, I don't know if we care. This is one of the perils of banking with us. And if you want to go try and bank somewhere else, you're welcome to, but it's going to suck more.
Yeah.
Like and there's one of the best books I've read in finance is Trade Wars or Class Wars. Have you read that one?
Mm-hmm.
It's so good.
Yep. Yeah.
Like the open capital account creates this dynamic where people are constantly saving with us. Like they're constantly they deploy capital in America to save it. And if we, it creates just a very strange loop here where when we do this thing here to solve inflation, it's going to hurt a bunch of other economies, which is going to reduce the amount of capital inflows, which is going to hurt us.
Right.
Like there is a recursive loop there. It's really kind of wild. I think it'll sting, but at the end of the day, the American geography will bounce back better than everybody else. We are always going to bounce back really fast. We can trade with anybody. It's cheaper for us to get goods to market. And so, we're going to cause a lot of global pain, and then we're going to emerge the victors on a relative basis. And it's going to be weird.
You touched on so many things.
Real weird.
Relative basis and American geography will bounce back, and you started with the blue ocean navies, and as you're saying, I think you and I have to deal with the idea is you have complexity dynamics, but then when you have complex systems integrating complex systems, you have integrative complexity, and then you have these recursive feedback loops. So there's no free lunches, and you don't know what the secondary, tertiary effects. I mean, like I always say, Poincaré, prove that with billiard balls, but yet we think we can understand the global macro environment. But part of what you said though is I don't think it's quite as easy, and I'm curious if you disagree with this. I like the Peter Zeihan approach of right. We have a blue ocean navy. We have this unbelievable geography, which gives us this unbelievable ability to grow food. Like we have all of these powers, right? And then we have demographics, right, that are kind of up and down the chain where most people don't. But then there's all these other things that people I don't think factor in. It's like all of our soft power. Everything that Hollywood ever produces, all the tech companies that Silicon Valley produces. So it's not like the dollar's just this one. Once again, it's not just this monolith that's enforced by our military.
Right.
It's enforced by so many different things, and then there's so many secondary, tertiary effects that are psychological. That why people want to invest in the U.S. and not look at a reserve currency in another world. But we don't think about the soft power effects.
Think about the levers that gives us. Let's say we had a demographic problem. What do? Turn on immigration.
Right.
Solved. It's unbelievable.
And nobody else can do that.
There's just so many. Nobody else can do that. Russia's turning on immigration by going and freaking kidnapping people. That's a little bit of an intense way to do it. I don't know if, I think there might be some backlash there. There is a ton of advantage. And I think that I can't see that shifting within our lifetime. Sometimes I had a whole little Twitter thing where I was sort of like, what would it take? What would it take to have another reserve currency? You have to have a meaningful shift in trade at a very basic level. The best I could come up with was space. So let's say, first imagine we solve power, whatever, some nuclear thing, whatever. Power's very cheap now. And now we have space elevators, little I don't know, what's the thing? The carbon chains that everybody talks about, right? So, you get stuff in space very cheaply, you push it over somewhere else, and then they drop it down, and as it drops down, it raises the other thing, whatever. So oceans are no longer the thing. There's a new trade lane, and it's space. Then I think whoever controlled space would be the reserve currency. That's my best case for the dollar is not the reserve currency.
But part of that is so it's always so hard when we talk about this because you have to admit your priors, right? We're both Americans, so everybody be oh, of course you're into American exceptionalism, and I'm like, I'm not at all, but maybe there's a bias I don't see there, right? But but just being circumspect about that, even basis that we may be biased in that sense, it's as simple as based on history, eventually one day the U.S. will not be the reserve currency. But based on the current environment and the inertia in the current environment, that's going to be a long ways off, and we'll be able to adjust. So the idea that we're going away tomorrow as a reserve currency just doesn't make any sense to me.
Yeah.
And so I'll play the hand that's
near-term case is balkanization, right? So America breaks apart, or we shatter this beautiful geography, and I think you could even make that case, the cultural fracturing finally gets us. We break apart this thing. We now have to trade with one another. That involves a bunch of friction. We disintegrate into a bunch of microcultures. And I'm like, okay, that's probably the best case for the dollar as not a reserve currency within our lifetime. I'm still not betting on that shit.
It's still going to take decades, too.
Yeah, exactly.
What's your time horizon,
tomorrow.
right? Yeah.
Yeah, maybe we see it. I don't know, but I would even, I'd offer odds that I never see it in my lifetime. Like, it's just there's so much that would have to happen. It's almost absurd to talk about,
Yeah, exactly. And over what time horizon? So when I think about when I think about I get my inner Travis going, when I feel like I actually feel like poking and prodding and trolling people a little bit, one of the ones I always bring up is like, you and I both know that like they don't print money, they print reserves, so we don't need to get into that debate.
Yeah.
But if I really want to poke and prod people when they say it, I go, they didn't print enough, and they go, excuse me, and like everybody gets upset by that, and I go, if you don't know the size of the euro dollar market, and nobody does, it could be argued that they haven't printed enough to ballast the euro dollar market. And I was hoping you wouldn't agree with me, but you're shaking your head. So
I don't know. It's like,
exactly.
how do you make a claim about something that's unmeasurable? I think that I think you could make inferential arguments, which are always a little weak, about the shape of the euro dollar curve currently, and suggest that like there's not enough. And you can also sort of have this sort of a priori observation that at some point there will not be enough, right? Because when you create money through debt, there's always more. You're creating more forward demand than you're creating supply of money, always structurally, unless rates are zero. So if rates are at all positive, you are creating more forward demand than you are you're originating supply. So at some point there won't be enough. Now timing that, impossible. It's a chaotic system.
But like you said, you brought up trade wars or class wars. I just find a lot of people on FinTwit like fall for this. They're always really domestic in their thinking, and then part of the domestic thinking a lot of times, I'll use domestic in both sense. They both think about it in a U.S. centric basis, but then they also think about it domestic in the sense that they think that the government is run like a household, and that like you can just pull these levers of like savings and expenses. They don't realize that like government accumulating debt is our savings on the private side, and then you start adding in current accounts and all of these offsetting forces. And like you're saying, if we don't know the size of the euro dollar market, and we don't know how the disruptions in that market, and then the repatriation of dollars, etc., like these are like cascades and levers that like you really can't address if you don't know the size of. And but people seem to be pretty strong in their opinions on they know the size and they know that we're doing the wrong thing, and it's just like I'm not so certain.
I have not yet seen that case made in a way that I believe. I'm open to the idea that someone could measure that market, but I don't know how you do it. I mean,
it's got to be impossible.
It's got to be impossible. Yeah,
it's a Hayekian problem, right? Because you would need accurate data from every country that's issuing U.S. dollar loans, and you would have to assume it's good data, not garbage in, garbage out.
Yeah, I mean, then you could loan me $1 million, right now. Like we could have a private contract. So in order to have that data be exposed, you have to be authoritarian about economics. You have to say private market lending is illegal, because otherwise you can't get a complete data set, right? It is immeasurable based on our cultural values. It will always be immeasurable unless our values change.
Well, part of that just made me think of that is like, I've never thought about this before, is like we even have different legal systems. Like we just happen to live under English common law, where other countries have completely different legal systems. So contract law is completely different in different countries. So once again, like you're saying, if you're issuing loans on a contract, it might not be amenable to figuring out the aggregate data sense in the way that we think about it. And one of our exorbitant privileges is actually that we are on that English system, so we can create enforceable contracts. And then you have bankruptcy laws and everything that like most other countries just simply don't have. Like people have no idea like how I always think about how lucky we are with just like 30-year mortgages, and most countries don't even have that. And non-recourse 30-year mortgages, this is insane.
Yeah, it's bananas. It's one of the greatest financial innovations is bankruptcy. It allows people to take a shot. It's sort of pro liquidity, right? It's pro liquidity. You can go out and you can take a shot, And if you fail, it doesn't ruin your life.
And I wanted to, I didn't want to have
That's a brand new thing. 500 years ago, that didn't happen.
Right. And it creates elasticity and opens us up for failure. And I actually didn't want to talk about crypto at all. But do you think that's probably one of the primary problems with sound money and inelasticity is you basically end up with debtor's prison and people are fucked for life?
I don't know that the concept of sound money survives meaningful investigation. I think it's a meme, and that's fine. As a meme, it represents something, right? What it represents is disenfranchisement and a feeling like the current system is not including a bunch of people, and that meme is right. All memes are right? Like it's representing something real. There's a reason people feel they rally around this thing.
It's like the meme of communism, right?
Yeah, and I think that the thing that crypto is trying to fix, we need to fix. I agree with. It's part of why I'm such a bastard about the solutions they were proposing, because we actually need to fix it, and instead you have these sort of childlike, regressive tropes that are not going to fix the problem, and are going to get a bunch of people invested in the idea that somebody's working on it when they're not. It won't add out to an outcome. It's a very big problem. We got an economic system that's leaving a bunch of people out, and so they're going to try to make their own, but like they're not doing a good job. And what we really need to do is help them access a system that will work for them. I mean, if they want to do it, that's great, but it's as an observer, it's not going great.
Do you think part of that, the part to me that benefits everybody is like if we upgrade like the fintech plumbing, if we upgrade chain of custody sorts of things, if we upgrade the ability of like Cantillon effects where like the farmer in Colombia growing my coffee has access to the same, cheap, loans that Starbucks has, or like when the actual purchase of that cup, it cascades through maybe a blockchain scenario like that. Are those the kind of solutions you're interested in, or am I just even getting too Pollyannish about that as well?
I don't see any strong case for blockchain at all. Okay. So let's set that aside and focus on the bigger stuff. You have peer-to-peer lending platforms, Prosper, LendingTree. You can go on there and apply. Well, why though? I mean, they're still out there.
Yeah.
I don't know if they've failed. I would say.
I don't think most people have made the returns they think they've made on those platforms as far as the investors on that platform.
Yes, so they've done a bunch of they have a pretty interesting data science practice. You have, you're going to get 5-6% in a blended basket, and if you go too far above that, the defaults make up for, somebody wants to borrow at 20%. There's a reason.
Yeah.
So what was revealed, they're so good. What was revealed by that is that even a peer-to-peer market is relatively efficient in aggregate, right? Like, not efficient market theory efficient, but it trends toward markets sort of converge on a similar price of money. And there's almost nothing fundamental that we can do to change that price of money because it's an emergent property of the system. So I think then we have to ask the question, who are the people who need access that aren't getting access? What are they trying to use those funds for? And how is that not served by better, and is it being better served by like SBA loans? Those things are cheap. You can make a half decent case for a lemonade stand and get an SBA loan. Like, so what is the rage here? Do people not want to make the case? Do they not want to do the work? I see some of that, and I'm like, tough shit. Work is work. I hear these arguments about like the disenfranchised and all that, and if you look through the history of finance, those same arguments happen during manias. It's predatory inclusion. So during manias, you have this, we're empowering people towards the end of them. I mean, the manias last a long time, as we're seeing. But towards the end of them, you get this predatory inclusion stuff, and I am aligned with what the narrative says it's trying to do, but I think it is likely going to be destructive and is part of this overall, hype fest.
Yeah, there's several things actually you touched on there that I want to pull out. One is nothing resets the Gini coefficient like an asset market crash. and people don't want to admit that, right?
Yes.
Like that's part of it. It's like you're just in a
It's
bull
the
market.
best
That's
way.
what. The
how
market
America
will
does
take
it.
care of it. It take care of itself. And then like the whole downstream effects. Everybody's like, well, we're really saving the people of like Argentina or Turkey, and I'm always like, have you ever lived there? Because I have. And there's money changers in every corner. The rich have actually. Have amazing banking system in the U.S. That's the best tax haven for them. Like,
That's right.
who do you actually think you're saving? Because you're not doing what you think you're doing. The third, though, what I wondered is, like you just said, there's an emergent property that takes effect where we find out the price of money. But then would that negate what you said earlier about you believe that maybe interest rates are causal from like the Fed funds rate?
That's a good question. I think so. So let me amend it. Interest rates are causal, inclusive of the Fed funds rate. They cause the Fed funds rate.
So that's what I'm saying. What's the chicken and egg? Who's the primary function? Is it the market sets the interest rate, or does the Fed funds rate set the interest rate that then the interest rate plays off of?
I think market dynamics set an interest rate as the aggregate output of all economic activity, which the Fed then follows along and takes credit for. And that aggregate output of the activity then shapes forward activity. This is one of these, these chaotic loops,
Yeah.
It's
But you just said it.
things.
You said it eloquently. But that's okay. So now it makes sense because I thought you were disagreeing with that. But the way you just put it is exactly the way I think about it. So like that. Okay, I thought we were disagreeing previously, but that makes more sense.
Here's a really funny thing with the whole bond thing. So, what the hell is reverse repo, right? You have this whole huge pool of money that's sort of like a sidecar. So you get this buffer stock mechanism on either side, right? Reverse repo, standing repo facility, and they're raising rates, and what that's causing is this money to pool into reverse repo. Where would that money be if that facility didn't exist? Well, it would be in short-term treasuries, right?
T-bills, I would say, 90-day
T-bills.
T-bills, or yeah.
Okay, so what does the curve look like right now? Really, it's hard to say, right? It's hard to say whether our historical comps for the curve that we're seeing here are good or are giving signal without accounting for this new facility. So there's I think that a lot of what the Fed does is this Wizard of Oz dance where we have introduced a bunch of stuff to kind of manicure the optics around what's going on in the bond market and a lot of different things, but I'm not convinced that the crushing weight of economic gravity can be modified by anyone. It can be dressed up, it can be presented in different ways, but ultimately I think that thing's bigger than us. I'm like a free market maximalist, not as a moral thing. I just think it's an observable truth. You read some as Adam Smith said. It's like he was talking about free markets not as a political position. It was just like a thing, like gravity. It's like this stuff happens, things flow downhill. If we want to put a rock in the way of it, it will flow around the rock.
What's interesting is when you just brought up like the descriptive nature of Adam Smith or like the descriptive nature of monetary operations. Nobody actually wants to talk about that. They want to talk about the politics on top of that. That's right. They don't want to actually talk about the descriptive qualities, and that's where the arguments start to begin. And speaking of which, I want to kind of circle back to the beginning of our conversation about philosophy and business and kind of end on this discussion is the idea of you are an epic troll in the most positive way on Twitter. It's unbelievable. And I watch with just awe because even though, so you were saying if you're trained in philosophy and those sorts of things, you're trained in debate, clear thinking, defining terms, all of those sorts of things, which gives you that love maybe for the trolling and the debate. To me, I just like to observe. I just don't have the energy or the capacity to deal with the counter trolls on that. But one of the things I wanted to maybe touch on there is the idea of, I've been thinking about this recently. I'm sure you do too. I have a lot of friends that are writers, and writers going to write, and writers going to tell you that the clearest way to think is to write, and that's how you get your thoughts out, and that's how you debate yourself. I would actually argue the premise of the original construct of philosophy was actually a dialogue, that you had to debate your ideas in real time, and that feedback loops gave you a tighter iterative feedback loop. where then you got to really test your ideas in the fire of dialogue and really sharpen and hone your ideas through dialogue. And it seems to me we've gotten far away from that, where it's like, if I write and then I edit 20 times and it comes out a year later, they think it's a well-honed idea, but you are just debating yourself. And you didn't get outside of your own ego. And so does that also like to you, it's just like it's a way of taking your, because I know you're a great cook too. It's like a way of taking you're honing your kitchen knives. You're just honing your mind and your debate and your philosophy skills on Twitter in real time.
Absolutely. That's what it's for. It's why I like finance too. People fight back. You know, if you're going, there's a bunch of topics on there. You can go in there and people are just like, oh, well, that's a nice opinion. Not finance. Finance is great because an opinion has downstream consequences that are financial. And so if you go on there and you're sort of chatting about financial things, people get really into it. I think it is the best arena for sort of honing the mind, just for that reason. People are very invested. And so you get a lot of pushback. You know, it's a dojo that people are always down to roll in. It's great.
But how many times do you wake up and you're like, I'm going to troll the crypto community. This is going to be a fun day.
I mean, it sort of happens a lot, but usually I don't really put a ton of thought into Twitter. You know, it's what I like about it. Yeah, so I get this sort of suggestion I should write a book. I'm like, oh God, maybe I will someday. I always wanted to be a writer as a kid. It's like, that sounds kind of heavy. What I really want to do is go, you know, I'm like walking to lunch and I'm hammering out an 8-tweet thread, and I just want to see if anybody thinks it's wrong. I love it when people come in thinking it's wrong. There's nothing, with somebody telling you you're wrong is the greatest gift, right? Because if they're correct, you're about to learn about a blind spot you had. And then you can sort of incorporate that, and should be like T2, the Terminator, right? People come at you with bullets and you just get bigger. That's what Twitter offers.
It's an anti-fragile process. Or like the way I like to think about finance, for me at least, is like, or life in general in finance is like, I'm trying to unlearn all the stupid stuff I've learned, right? And if I can eventually simplistically, if I can figure out what things mean in a simplistic sense, right? If I can explain it to a 5-year-old, I actually finally understand it. So there's a lot of autodidact nature to that. But then the other part of it is like, if I can steel man both sides of the argument, in the Carnegie sense, then I should negate that argument. And so therefore, like, but that leaves you in a world of hurt of like, how do I construct portfolios if I don't have a definitive opinion in one direction or the other? And then that's what I love creating, is portfolios of like, I can't predict the future and I know nothing. What do I do with my savings?
Yes.
And that's just exciting to me.
That's right. I love that. I think that is I think it's the proper way to approach markets, is you just have to go, you have to account for any thesis that you can't destroy.
What do you think about, are you, as an operator, do you feel you're ever distracted by Twitter or global macro?
I mean, I'm able to put it down pretty easily. It's what I like. It's so fast paced. Like it's the anti-golf. Golf is like, you're gonna go out onto the freaking range and play 18 hole for a whole day. I'm bored thinking about golf.
Yeah.
Twitter is so bursty. I mean, it takes 2 minutes to engage on Twitter. It's like I'm waiting for someone to show up on a Zoom meeting. Boom, that's my Twitter engagement. I think that I do get fairly obsessed about global macro, and I'll go on these long, sort of learning curves. But I typically go into those when I'm going on a road trip and I need an audiobook. Mostly when I'm in the saddle. Any sort of incoming comms from my team at work takes priority over everything during the workday. And that's just like, it's so deeply wired, I don't even think I could turn that off. Twitter's just not that important. It's the delight of it. It's not that important. I'm not selling anything on there. Maybe if I was trying to hawk a book, or I don't know. Again, like if I wrote a book, I might ruin my Twitter experience. I like my Twitter experience.
If you wrote a book, here's my what I would want to see. Like, one, I think about, I say all the time that commercial real estate development is actually a good precursor for learning about business and global macro, because you have to understand debt markets, and you have to understand the delta between the project and the different time horizons and time cycles. And then global macro global macro liquidity event can erase your entire pro forma P&L for the next 2 to 3 years. So like there's issues with that. So I think it, to me, is like, if you wrote a book, is like, your autodidact journey to really understanding treasuries. Because if some people can really learn that, then that gives you the foundation to kind of maybe understand everything else. And I think that's the least talked about part of finance, or the area of finance, and I might be biased about that.
That might be. I mean, I like that idea a lot. I like the idea of you start with this sort of the core structures and go out from there. Treasury book would be fun. There aren't very many. Sometimes I get asked, like, what's a good way to go learn treasuries? I don't even know. It's a very weird market, Yeah.
I've been thinking about doing like a podcast or video series where you just go interview like as many people as take them along that journey process, that learning journey process, as you and I love those kind of things. But it's all, your homies that, whether it's Brent, Steven, Lynn, like all of them are like but you have to bricolage that together over years. And like, that's a hard way to learn. There's no sort of A to B to C to D, and this is the problem with finance in general. The only way to learn it is by just jumping into the deep end and spending years in it, because there is no education process. And every time we talk internally, like, how would you build up that education? I really have no clue. It's really hard.
I have no idea. It's very hard to think about. It's similar to business. There's no end all be all business book. There's these business books that are like little fragments, and you get a little nugget here and there. You're like, damn, that's a really good one. But I think you could do a sort of like Treasuries 101. That would be fun.
All right, future plans. But I want to thank you for coming on the podcast. I always enjoy our conversations. Well, obviously, one day we'll rip off the Band-Aid and talk about crypto, but that's going to be a 2-hour podcast, so I was trying not to touch on it this time. I just want to thank you for coming on. I always look forward to it.
Appreciate you having me. This was awesome.
Thanks for listening. If you enjoyed today's show, we'd appreciate it if you would share this show with friends and leave us a review on iTunes, as it helps more listeners find the show and join our amazing community. To those of you who already shared or left a review, thank you very sincerely. It does mean a lot to us. If you'd like more information about Mutiny Fund, you can go to mutinyfund.com. For any thoughts on how we can improve the show or questions about anything we've talked about here on the podcast today, drop us a message via email. I'm Taylor@mutinyfund.com and Jason is Jason@mutinyfund.com, or you can reach us on Twitter. I'm at Taylor Pearson ME and Jason is at Jason Mutiny. To hear about new episodes or get our monthly newsletter with reading recommendations, sign up at mutinyfund.com/newsletter.
This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Mutiny Fund, their affiliates, or companies featured. Due to industry regulations, participants of this podcast are instructed to not make specific trade recommendations nor reference past or potential profits. Listeners are reminded that managed futures, commodity trading, forex trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they're not suitable for all investors, and you should not rely on any of the information as a substitute for the exercise of your own skill and judgment in making a decision on the appropriateness of such investments. Visit mutinyfund.com/disclaimer for more information.